Hello everybody, my name is Mark. Welcome to another one of my investing videos. And in this video, it's been an interesting day for me. My position here, I own 200 shares, and I do own a spread on Microsoft, but I'm mainly going to talk about steel because I opened an option collar on steel a few weeks ago, and I own 200 shares of steel right here. And steel dropped by 9.83%, went down $1.94 a share because some hedge fund downgraded them to $13 a share, and I can't even believe how much stocks move based on the hearsay of these hedge fund managers or whoever it is that's talking about the share price. But steel went all the way down to $17.80. I own 200 shares, but because I opened an option collar, I bought to open two $20 puts, and here they are right here. The bid is $5.10, the ask is $5.30. The last price was $4.92, but it has since gone up to bid of $5.10, $5.30, and I paid $3.99 per contract for those. So these puts are up $120 a contract on those. And then these are my calls. I sold these are $24 call options, expire in May. Today is April the 9th, 2019. That's about a month from now. And I sold to open these calls for $53 a contract. Let's go to my transactions and I'll show you exactly the transactions that I made. Let's go ahead and put in December steel right here. There it is right there. And let's click March. That would have been in March that I opened all this up. And so there it is right there. Those are the 200 shares. The reason why you see two orders there is because of a mouse error. But 165.35, and I accidentally canceled order, and 35 shares got filled, so I had to spend a double commission thanks to a dumb mouse error that I committed. But moral of the story, I bought 200 shares of steel, and dollar cost average $20.66. And then here are the put options, $20 puts, expired January 2021. Those are leaps, and I spent $3.99 per contract, total cost $806.48. And then these are the $24 calls that I sold to open, took in $53. Those expire May 17th this year. That's about a month from now. And so I took in a total of $97. This right here you see is a little swing trade that I did. The whole position I opened up on the 12th, and then 10 days later I sold to open some 16 puts, took in $39 and $69, and then I bought to close those for $50.48, so I made an extra $19. Not a lot of money, but it's a little, and every little bit helps. Okay, and so these are the transactions. Now I put all this on PowerPoint so that it's real easy to see, and so here is the first slide here. This is my position in a nutshell. Number one, 200 shares of steel, dollar cost average $20.06 a share, and then $20 put options expire in January of 2021, $399 a contract, and then these are my $24 calls for 2019 May. Those expire a month from now, and I took in $53. That's my position, easy, nice and easy to see on PowerPoint. And then next slide here, steel's current price dropped down to $17.70 a share, so that's a loss of $2.96 a share. Now, if I just bought the stock and I didn't even fool around with options because I think stock options are so risky and I don't make any money and I don't know what I'm doing, then I indeed would be having a bad day because I'd be down $2.96 a share. I own 200 shares, so I'd be down almost $600. But because I bought to open these $20 puts, those went up to $520 a contract, so I made a total profit of $121 a contract. And then these $24 calls, those dropped all the way down to $6, and so I sold to open those for $53, and so I made a profit of $47. So if we go here is the end all be all. Okay, so I took a $296 loss in my share, and this is all times 2, and then I made this $168 profit. And where does that come from? That comes from this profit, 121, and I add those two together, that gives me 168. And so instead of losing 296, I only lose $132 a share. So I cut my losses from $296 down to $132. I saved myself $168 per share. So I literally cut my losses by 50%. 6%. So you can multiply all this by 2. So because I own 200 shares, my total loss is this $132 times 2. So I am down $264. Now that is a whale of a heck of a lot better than if I were to have just bought the shares. And there it is right there. So for the day, I'm down a whopping $138.96, which is not bad, given that my main holding right here, Steel, my major holding, 200 shares, 11% of my portfolio, right? That's really not that bad. Okay, so option callers do a wonderful job of protecting yourself, and it's just like buying insurance, right? You buy a house, you buy homeowners insurance. You buy a car, you get car insurance. You buy stock, you buy put options. Put options are contracts to sell your stock, and if the stock tanks, like Steel did, then the put options, which again, we go back to my transactions here, and I put in ticker symbol Steel like that, and then I go to March. Right here like this, click the view button, and there it is right there, $399. That's what I spent for those $20 puts. And if we look at those $20 puts in my positions, there you go right there, those $20 puts, they closed at $492, but the bid is $510, the ask is $530. So those $399 puts are all the way up to $520. So that's a profit of $120 on a $400 investment. Now, if I had skills, if I had a crystal ball in my brain somewhere, then and if I would have just bought those puts, then that's a pretty doggone darn good return on a $400 investment. You make $120, that's a 30% return, right? But since I don't have a crystal ball, and I tend to buy stocks, and I do these option calls for a reason, because I don't know what stocks are going to do. I don't have a crystal ball. And 9 times out of 10, I'm dead wrong on what the stock's going to do. And if we take a look at why Steel went down, I think Ameritrade even says somewhere in the news. Where is it at? Here it is right here. United States, right there. United States Steel down 8%. Credit Suisse cuts to underperform, and they said that Steel is going to go to $13 a share. So because of this hedge fund, which I never even heard of, comes out and says Steel is a bad stock, and here it is right here, U.S. Steel stock price target cut to $13 from $21. And so apparently, because this hedge fund seems to know everything, and they say Steel is going to go to $13, then everybody's going to go, oh my gosh, you know, I better sell, right? And for me, I mean, yeah, I did lose a little bit of money, but at some point I'm going to buy more shares. And I'll close this video out by showing the fundamentals, and I'm going to go to my trusty website of FinViz here, and we'll take a look at Steel, and you'll see that the numbers really are not that bad for Steel. So let's go ahead and put in ticker symbol Steel like this, and click the search button, and then let's go to the earnings per share. So their earnings per share right here, that's their trailing earnings per share, is $6.25. They're making money. They're making $6.25 per share. Now next year, for some reason, the forecast, they're only forecasted to make $2.48 per share. Oops, let me shut that down. And so again, that's just speculation. Who knows what Steel is going to do next year? Maybe it's because of Donald Trump and the tariffs and trade wars in China. I don't know, right? Earnings per share this year, 260%. And look at this, right? Their return on equity, 29.4. Now, anything above 15 is good. So this is almost double of what the average should be, right? And their debt is very low. They only have a 0.57 debt. So all of these numbers look good. They're a huge company. They're a $3.1 billion market cap. So they're a huge company. They're making money. They're not losing money, even in this crazy uncertain climate. They still have good numbers. So why in the heck am I going to get out of Steel? I think the option collar is a perfect strategy for a stock like Steel that is very volatile, that is very vulnerable to the climate of this country. There's a lot going on right now. It seems like every day the news comes out. There's rumors, there's cuts, there's hedge funds that are saying, and analysts that are saying that we're going to have a recession. But that's the reason why I do option collars, because if I just bought stock, then I would be suffering a lot more than I am now. I might be suffering a little bit, but I can handle this. I can handle losing $138, having a little tiny down day. That is a 0.42% loss on my money overall. So I can handle that. So if you are going to get involved in options or really just investing in stocks, consider the option collar strategy. Okay, when you do an option collar strategy, you just pick a stock that you feel good about, a stable company, one that has some good numbers, earnings per share, low PE ratio. And by the way, if we look at their PE ratio is 2.84. I mean, it doesn't hardly get any better than that, you know, but I digress, okay? If you're going to do an option collar, pick a stock that you feel comfortable and buy some shares, but then buy to open some put options. Why do you want to buy to open the put options? Because put options are contracts to sell your stock so that if there is a recession or a major sell-off like there is with steel today, then your put options will protect the value of your shares, because my put options, as you saw, went up from $399 per contract, which is what I spent for those $20 puts. Now those puts are all the way up to $520 a contract, and these are my puts right there. 492 is where it closed. The bid 510, the ask 530. So if I got it in the middle, 520. So I'm pretty happy with that. And then the calls, you sell to open the calls, and these calls are probably going to expire worthless. But if they go down to $4 or $5 a contract, I'll probably just buy to close and sell some lower strike price calls. And another idea that I had is, actually I got two ideas. My first idea was to sell to open some put options, and if I were to choose the same expiration of 37 days, I can get $50 for the $16 puts, which, by the way, that's my break even. These are my $20 puts right here. Okay, and there you see it. The bid 510, the ask 530, and those are my puts. And because I spent $399, 20 minus $399, which is 20 minus 4 is 16. So $16 is my break even. And I could get $50 if I sell to open. Those expire in 37 days. Now, I'm probably not going to do much of anything for a little bit, because there is an earnings coming up, and the earnings coming up is on May the 2nd, 2019. And also, I want to wait to see where steel levels out. I mean, is steel actually going to go to $13? Maybe it is. So I want to see how far down steel is going to drop. Is it going to keep plummeting? What's it going to do? You know, but whatever it does, I have no worries. I have no concerns, no issues. I don't care what steel does. If steel goes down, my $20 puts could go up to $700 or $800 a contract. And if it does that, then that would be wonderful, because then I'd just flat out sell to close my $20 puts and probably buy some $16 puts or some $15 puts. And then I would really take a chunk out of that dollar cost average of $20.66 a share. So again, consider the option collar. If you're an investor and you don't want to deal with the volatility of these spreads, you know, like I have spread. You see all this Microsoft here? I have spreads on Microsoft, and I'm finding that doing spreads, diagonal spreads, much more challenging to manage than these option collar. Option collar is more of a sit and wait around, you know. It kind of helps to build your patience a little bit, because you're sitting around waiting, basically just waiting to see what the stock does, and then wherever the stock closes here in the next 37 days is going to determine what strike price cover calls that I sell, or what puts that I sell to open, if I want to sell to open some puts, or if I want to close my $20 puts and just buy some cheaper puts. I mean, there's all sorts of flexibility. The option collar is a great strategy if you're an investor and you want to get into options. You know, get away from selling these covered calls. Think about it. If I would have just sold to open the covered calls, no puts or nothing, I would have made $55, but I'd be down to $296. That's an extra $120 a share of a loss that I would take. So I just saved myself $120 buying that little bit of insurance, like that homeowner's insurance, car insurance. So the option collar gets my vote as one of my favorite all-time strategies for options. Being an option trader, it's a great strategy. It's safe. You can buy any stock that has good liquid options, has a good numbers, earnings per share, has a good strong chart, and you know steel is going to be around. Or if you want to do Apple or whatever stock you think looks good, you know, get into the game, jump on into it, buy some shares, do an option collar, buy some puts. If you have any questions or any comments, and you need a little bit of help or advice, like how to set up your caller a little bit, because you got to look for good setups, but they're out there. They're all over the place. They're everywhere. These opportunities abound. This is a good market we live in. Twitter is a stock that I've been thinking about getting an option caller for. Intel's a good stock for an option caller. And I mean, there's others too. I can't even think of them all. There's lots of good stocks that you can invest in. You can buy some puts, sell some calls. The money that you make on the cover calls pays for the money that you spend on the put. And basically, it's like being able to own a stock for no risk. And how can you beat that, right? And probably you can expect to make an average of about a 5 to a 10% return on a yearly basis. And what's wrong with making 5 to 10% return for almost no risk? What is wrong with that? I mean, are you really so gung-ho that you think you're going to make a 10% monthly return, or you're going to make 50% return a year? There's lots of people out there that will sell you day trading courses, and they will teach you how to do that. And I invite you, go ahead, give them your money. Or you can just keep watching my videos for free, and you can watch how I'm trading my own money as my real money. And I've said from the very get-go that I'm always going to be transparent. I'm always going to do a video if I lose money, and obviously I did lose a little bit of money today, but whether I lose money or I win money or anything in the middle, I'm always going to be transparent. I offer these videos as a free service because I think being an investor, being an option trader, it's difficult, it's challenging, and I just believe that we need to work together, build a community, and talk to each other and try to help each other out. And I don't think we should take advantage of each other and take each other's money, because I think I have the secret sauce and nobody else does it better than me. So that's it for this video. If you enjoyed this video, hit the like button, whatever you want to do. Thank you for your support. And as always, if you have any questions, feel free to leave in the comments, and I will see you in the next video, and have a good day.